In this week's update, what leads the US market now? How to outperform most others? And gold breakout is on in earnest. My name's Garry Davis. As always, this is general advice only. And please remember to like and subscribe to the video. Let's start with a normal market perspective. What is the norm? When markets have been running as hard as they have, 5 months in a row, the US market has been going up. What is the norm when you look back over the last 10 or 20 years? And the answer is that at the index level, at the S&P index level, the index rises about 80% of the time. Whether you measure it over periods of months or quarters, that's about the right number over the last decade, about 80% of the time, and 20% of the time, the index is in downtrend. So what is reasonable? So that's across from say 2014 to 2024. There's been a lot of things happen during that time. We've had a couple of significant corrections in the market, and then of course the COVID crash. So it's not a bad cross section of different market conditions. So what is reasonable when conditions are as good as it gets, which is what I've been saying that since the start of this year, that we now have in 2024. And I've explained that before. It's abundantly clear why that is the case. It doesn't mean the market has to go up. It just means that conditions are as conducive as you ever would get them for the market to go up. So what is a reasonable expectation? Is it more than 80% or is it less than 80%? And I think the answer to that is pretty obvious. It's going to be more than 80%. And that's just at the index level. Then you start to drill down into the sectors and the industry groups and individual stocks, and the outperformers, the best of the best, absolutely smash the rest. So when you put that hierarchy all together and step back and look at it, instead of maybe agonizing about whether, the market's gone, too far, too fast, so you get all wobbly about it, just step back and look at the reality of where we find ourselves. And then if you can zero in, not just address the general market, but zero in on the outperformers, then you can see, hopefully, that you can do exceedingly well during these periods. The danger, of course, is that we can get stuck gazing at the party. It's a great time, you're making money, things are going up, the story always looks great somewhere near the peak. It never looks better than near the peak. And I'm not saying we're at a peak by any stretch of the imagination, but that's just the reality. Then it's easy to get stuck enjoying the party or just gazing at the party. So be on alert for rotations, and we are getting a rotation right now, which I'll show you. Now, is it a significant rotation or is it just a minor one? I don't know at this stage, but I'm certainly watching very, very closely, and I'm not assuming that the sectors and the stocks that have led this rally since the end of October last year are going to just continue on in the same fashion. They may do, but then again, others may come to the fore. And we're certainly seeing, if you look at the Russell 2000 or the ETF that covers it, which is IWM, the character has changed of that index. There's no question. Again, you'll see that very clearly on the chart. These aren't guesses, these are predictions. These are just observations of what's staring us in the face, where the money is actually going. And in the last week or two, big tech has started to underperform. Now, it doesn't mean that they're necessarily going down. It just means that they're being passed in terms of leadership by other sectors. So this is a time certainly to pay attention. And if you don't know how to spot the difference between just a short-term garden variety, one step back in an ongoing uptrend, and the end of a run turning into something more significant, then you need assistance from someone who's far more experienced than you are. And there are a lot of nuances around picking the difference, because at the start, they often look very similar. But there are certain things that you can track that give you more insight into that. And you don't get that insight from just looking at one indicator or two indicators. You've got to be looking at 10 or 20 different indicators to get a sense of that. Now, the US market has been overbought since December. So the market bottomed out on the 27th of October, and it rose very, very strongly through November, started to look a little bit overbought in the classical RSI sense early in December. By the end of December, it was looking distinctly overbought. But guess what? It's just continued to march on. And 3 months later, we're still marching higher. And there's really been no pullback at all. There's only really been one small down week and a pause in the last 15 or 16 weeks in America. So what you've got to do is put aside the natural gut feeling is that this has to stop. It's gone too far, too fast. It just has to stop because it just sort of makes logical sense. It just feels like that's what should happen. So you've got to put that aside because, again, when you stand back and look at this objectively, what is the last 5 minutes telling us? It's telling us that there is incredibly powerful buying support. This is not hype. Prices aren't going up because of hype. AI is real. Earnings are real. Earnings growth is real. 70% plus companies are still beating expectations. So this is real. So you've got to look at it the other way, put the emotions aside and recognize why the market is going up. And what we're seeing now in very recent time is that the rotation is certainly broadening the rally. More and more parts of the market are joining in, which makes the rally more sustainable. Now, the indexes might just go sideways because the big tech stocks have such an influence. And if they start to go sideways or down a bit with some profit taking, then the indices aren't going anywhere. But that's not what you should be looking at. You should be looking at the sectors and the industry groups and the stocks that are really starting to outperform because that's where the money gets made. So definitely don't be watching the index. So how to approach it? Look, I hammer this week after week after week, and I've been doing so for 16 years. You just got to be really clear about your plan or your process. And if you can't be bothered doing that, sitting down and figuring that out and being a bit diligent about it, then you shouldn't be in the stock market, in my view. So you just got to be very clear about the plan that you're operating or the process that you're using. Keep an eye out. Don't get caught gazing at the party. Look out for areas where momentum may be waning or there may be reversals occurring when stocks have become overextended. And there's certainly quite a few that are in that position. They're very extended, but are there obvious signs of reversals? Not really that I'm seeing, not in any sort of general sense. So this isn't an alarm bell. This is just a reminder, hey, don't get too engrossed in the party. And the other thing is, and a lot of people want to do this because they've got all these great profits and they don't want to give any of it back. And so they start to sell out too early. And that could have been extremely expensive if you've been doing that over the last few months because some stocks have done unbelievably well. So let the market action take you out, not that voice in your head, that seemingly logical voice in your head, which is really emotionally based. Have a method of exiting, taking profit that lets the market action do the thinking for you, if you like. All right, we'll get to the charts in just a minute. The S&P was up 0.4% for the week, was down a bit early, but certainly finished well. But it was up 10% for the quarter. So that's 40% annualized. Now, I'm not saying that we're going to get 40% this year. I think that's incredibly unlikely. But 10% for the quarter is 40% for the year. So that is a fair old clip for an index the size of the S&P. And the S&P was up without technology leading. In fact, technology, I think, was the lowest or second lowest sector for the week. There were all 9 or 10 other sectors actually outperformed the technology sector. It was also very impressive, and I spoke about this last week, we've been in a blackout period for corporate buybacks in the final couple of weeks of the quarter. So there wasn't that liquidity in the market, and yet for the market to still go up, and there was an awful lot of stocks that did really, really well. It's very impressive market action. There's just no two ways about it. The US dollar index was higher, 104.5, and the 10-year yield unchanged around 4.2, and the VIX also pretty much unchanged at 13. Let's go and look at some charts. We'll start with the S&P. So this is a weekly chart, so you can see we edged ahead a little bit, but it's been the run since the 27th of October that has been pretty awesome, from 4122, and we finished at 5254. So it's put on about 1,100 points on the S&P. So that's an incredible performance across those 5 months. Let's look at the key internals of the market. This is the NASDAQ versus the S&P, and this is really interesting because the NASDAQ has been leading the S&P, the aggressive sectors leading the way for a long period of time. And we're now just starting to see lower highs and lower lows. We've not seen that since this started back in January of 2023. So 14, 15 months. And now we're seeing lower highs, lower lows. Now, that's not necessarily a disaster because that's relative performance. You should look at, well, what is the NASDAQ actually doing? So the NASDAQ hasn't rolled over, but it's certainly starting to struggle. It's losing momentum to a degree, and that is manifesting itself as relative underperformance compared to the S&P. So that's interesting. Now, it's no reason to rush out and dump all your NASDAQ stocks or your aggressive stocks in Australia, but it's just something to be aware of. And in fact, it's something to take advantage of. There is a rotation going on, which means that there are other stocks now that are probably better value that can offer more upside than the ones that have been leading the way. So see it as an opportunity, not as a negative. So there's the NASDAQ. Let's look at the semiconductor sector. Pause. This is a weekly chart again, so a bit of a pause over the last 3 or 4 weeks, but you can't look at that and say that this has rolled over. There was a little bit of a scare a few weeks ago, but it was one session only. And when you look at it now, it's a non-event. The SMH has continued to rise, and semiconductor stocks are just having a bit of a pause, which is actually healthy. I'm actually really pleased to see this. And if we look at semiconductors versus the S&P, not much change there really. It's just, it's not rolled over. It's just consolidating at a high level. Let's jump in and look at the individual sectors. So energy over the last quarter has now really reasserted itself. Energy was lagging through the second half of 2023, but it's really reasserted itself now, and it's at the top of the pack. We've got communication services is still doing well, but losing momentum. So that's one of the more aggressive sectors. Finance has done incredibly well. Look at the rise of finance. It was down near the bottom back here a quarter ago, but finance has done incredibly well. Healthcare comes next, then materials, and then we've got technology, and technology is definitely losing momentum. And then we've got consumer staples and consumer discretionary bringing up the rear. So that is what it looks like in the US over the last quarter. If we go in a little bit closer over the last fortnight, it's a bit of a jumble, really. A bit of a mixed week. Energy, consumer discretionary, and also communication services. So that is the US market. And also it's not showing up on this chart, but I could tell you that the industrial sector, which is a very broad sub-index, is also doing quite well. And there's quite a few stocks that are breaking out within that area. Turning to Australia in the last quarter, information technology has led the way by a long stretch. Finance comes next, small caps really picking up, and there's an opportunity in Australia. There's definitely some significant outperformance happening in some parts of small cap land. Healthcare, um, energy starting to pick up, but the energy in Australia is so much more difficult than the energy sector in Australia. And it's largely around government policy and just the pretty sad state of decision making in this country. So that is where the money flows are headed at the moment. There's just a couple of the charts I want to look at. That's the big picture. S&P going back to 1985 on a monthly chart. This is the equal weight S&P. So it's certainly keeping pace with the market cap S&P. This is IWM. So this is on a weekly chart, and this is where the character has changed. So the market started to form a very significant consolidation in August of 2022. So we got peaks then, again in February 23, July 23, December 23, with a minor breakout, and then it pulled back and for the first time formed a higher low. See through here, there's not really a pattern, higher highs and higher lows. It's just going sideways. This is the first time that we've had a higher low, and now we've broken out, and now we've got confirmation. So we broke out 4 or 5 weeks ago, came back, retested the breakout, and now we've got confirmation. And look at the volumes over the last 10 or 12 weeks. So there's no question that the character of IWM, which is the Russell 2000, has changed. And so therefore, rather than wring your hands about the fact that maybe NVIDIA and Microsoft and Apple aren't going to lead the market higher, go and look for the stocks that are, because there are plenty of them. There are hundreds of them. So that's IWM. And just to reinforce, this is MDY, which is the mid-cap 400. So this is sort of the middle group. It's also in breakout, and I'm pretty sure this is all-time highs. Yes, it is. We've got all-time highs on MDY as well. So very, very impressive in America. That's all I wanted to show there. So that's the US market. The Aussie market, 64.5 is where our dollar finished. I'll show that in a minute. The ASX 200, for what it's worth, it was set a new all-time high, up nearly 3% for the week, and I would expect that we'll probably get a pretty decent start into next week after Easter, because there was just such a powerful finish for so many stocks and across so many sectors, and we've now got very substantial breadth in the Australian market, and we had all 11 sectors higher certainly on Thursday, and quite possibly across the entire week. So the Aussie market starting to pick up, and there's terrific opportunities, as members of the Insiders Club and portfolio analysts will know, because they're seeing on a daily and a weekly basis. Let's just go and have a look at some of the Aussie markets. Just before I do that, we'll just look at the currencies. There's a DXY. So we bottomed out in early March. So the last month has pretty much gone straight up, and the Australian market reflects in the opposite direction. ASX 200, minor breakout, retest. And again, this is a weekly chart, retest in the middle week of March, and then the final 2 weeks of March, when it would be not abnormal to see a bit of weakness, they finish very strongly. So that's a good sign for the rest of the market. Precious metals, gold had a fabulous week, up $66 now to $22.32. So the gold breakout is really on in earnest, and with outflows from global ETFs. Now, whether it's whether money going into cryptocurrencies is stealing money flows from gold, or just, whatever the heck it is, reason that money is flowing out of gold ETFs, the buying is being done by the central banks. It's got central banks thumbprint all over it, because they're the only other source of significant revenue that can be driving precious metals as it is. Of course, there is a little bit of a currency effect always with gold, but of late, the US dollar's been going up, and yet gold's been going up, so it's not that. And the other really significant dynamic always, and I think this has been probably, putting aside, whether central banks are buying or not, because they're not going to be so worried about interest rates. But when real interest rates, so the nominal rate less inflation, when that's positive, gold struggles. When that's negative, gold does better, because investors in gold, which doesn't pay a yield, are not missing out on anything. So that's a driver at the moment, and that's a little bit, whether we're heading towards, I think we are heading towards neutral or perhaps negative real interest rates again. And so the gold market is anticipating. I don't think we're still on positive real interest rates at the moment, but the gold market is anticipating that trend. In Aussie dollars, we're now at 34.26 in Aussie dollars, which is a tremendously profitable area for Australian producers. Now, stocks are starting to respond, whichever index you want to look at, but there's no general outperformance to the underlying metal yet, as you'll see. But history shows that at some point in the cycle, and we've either started it now or very close, or it's coming in the next 12 months or so. But history shows that there will be a time when the leverage of gold stocks really starts to come into play, and gold stocks will start to outperform the metal by a very big margin. And that's where you see 10, 20, 30 bagger outcomes for gold developers. So that one is yet to come. So don't lose sight of that. Let's go and look at the gold market. We'll start first of all with, this is the Aussie dollar. Gold price on a weekly basis really starting to accelerate to the upside now. So that's very profitable territory. This is gold on a daily basis. So you can see a great move. We had a big spike on Thursday the 21st, which I remarked about last weekend, and we finished off in terrific fashion. If you look at that on a weekly, it's pretty impressive. So big breakout here, the first week of March, a pause the following week, probably another pause the week after that, and then last week really got going and finished very, very strong. If we look at GDXJ, so this is the overall index for global gold stocks, leaving aside the super majors. Yes, it's gone up in the last month. We've gone up from around 32 to about 38.7. But gold has gone up as well. Gold stocks should have done a lot better than this in the normal relationship that we see. This is the comparison between the Australian dollar gold price and GDX. So this is GDX in Australia. This is listed in Australia. This is the Australian dollar gold price. And the gold stocks, they're just not playing catch up yet, as you would expect. In fact, you'd probably even say that the Australian dollar gold price is still outperforming. At some point, that will change, and that's when gold stocks will really start to sizzle. But I don't know when that is. Just observe and respond. This is a bigger picture chart going back to 2010, and this is GDX in the US. So this is the big the biggest gold stocks in the world, versus the US dollar gold price. And you can see if stocks are playing catch up, then this line should be rising and rising strongly, and it's not. So I think that's still yet to come. And this is GDX in Australia. Really good move on Friday, lacking a bit of volume. Would have liked to have seen more volume, but we're now back to the top of the range. So we could be poised as far as gold stocks go in seeing a change in character and a change in sentiment. I mean, that's what's been lacking. It's still not confirmed, but it's looking a heck of a lot better than it did. This little period here, when you look at these the consistency of these higher volumes through here, it's better than what we've seen pretty much through this whole period. Hopefully this will now go on with it. There are some gold stocks, a small percentage of Australian gold stocks have been trending higher, but most of them haven't. And that phase is yet to come. The key question, of course, is if you got your target list ready. Don't stand around waiting for inspiration to magically fall out of the sky. You need to get your target list ready. It's what we do in Portfolio Analyst. It's what we do in Insiders Club. You can partake of $1 trial for 2 weeks in Portfolio Analyst, and there's a lot of ideas in that forum. Other commodities, copper unchanged, nickel pretty much the same. Crude oil continued to march higher, which is why the energy sector in America has done as well as it has, so up to 83. Lithium, just a bit of a perspective for this year. Spodumene concentrate price edged a little higher, back almost to 1,100. And the majors are looking better. If you look at a chart of Albemarle, ALB, it's definitely formed a base, hasn't broken out of that base, and may not for some months because it's not really being accompanied by volume. But the first thing that's got to happen after a sector has been smashed is that it's got to go through a basing formation, a sideways period of price action, and that has certainly been underway now for a couple of months. So that makes things look better in the lithium space. Wrapping it up, final thoughts. Don't be put off by the fact that there's new highs being formed in Australia and in America, and that the rally's been going on for 4 or 5 months. It's a logical thing to think about, but it's not actually very relevant. It's not helpful. There is significant profit to be made, and the stocks that do really well, that are 5 baggers, 10 baggers over lengthy periods of time. If you look back when they first start to move in the first year or so, there are multiple points where it would be logical to look at that trend and say, yeah, that's gone far enough. It can't keep going. And yet you look back 2 or 3 years later and it kept going. So there is significant profits to be made. So don't be put off by what we've had in the last 4 or 5 months. Just, first of all, make sure you've got a process, make sure you've got a plan, and just work that process and try and shut out the rest of the stuff. And that's what I try to do in this Sunday video, is to provide that perspective that can help you do that. Focus on your target list. If you don't have a target list, then hook yourself up with someone that can help you generate a target list, because your target is not the market. It's not the broad market. It's a small sliver of the market. The best stocks that have got the almost guaranteed earnings growth that is going to translate to high probability price gains. That's your target list. It's not the whole market. And if you want to stay on that roll, then don't get greedy, manage risk objectively, be aware of what your profit-taking methodology is, keep an eye on it. Don't, all the things I said earlier, don't get caught gazing at the party and forget to look at what the signals are actually telling you. Portfolio Analyst last week, this is what we did. We looked at how you can go about outperforming most other people in the market. And it's really easy. I should say it is really simple. It is not easy because of what's running around your head, but it is certainly simple. It is not difficult to do. You just need to be organised. So that's my sermon for the day, for Easter. I'll be back with you next week. There's more information on the website. My email address is there, and I'll see you next week. Cheers.